Mohammed Apabhai, Head of Asia Pacific Trading Strategies with Citi, joins us live. Mohammed, morning. Thank you for joining us. Let's first understand the big global picture. A month ago, it was all about what US Fed could do and how US tightening from US Fed could have impact on global liquidity. But suddenly, markets are of the view that Fed is unlikely to tighten and the cheap liquidity regime is here to stay.
Yes, I think it's very interesting that in the past what used to happen was that when you used to get towards these market turning points, like in 2008, 9, 10, 11, what you actually needed was a concrete injection of liquidity into the market. So you had the various QE programs. Now it seems like the mere jawboning and the mere talk of loosening policy is enough to keep people quite happy with what the central bankers are doing. I think if you look through the detail of what has been talked about, the Fed is still likely to be tapering in September. And instead of ending QE at the end of 2013, it seems like they're now going to go on until the middle of 2014. And I think the guidance is very much has been on the timing of a first rate hike. So I think the markets are very much reacting to that. We are seeing a short cover bounce going on, which is now turning into more of a long-only chase starting right now. And what we are seeing is some signs that there may be some rotation going on of new money from, let's say, the developed markets into a few of the emerging markets. However, we do believe that this is going to be a relatively short-lived phenomenon. We think this may last for maybe 6 weeks, taking us towards the end of August, maybe early September, before concerns over tapering come through again. Some of the recent US economic data has been a little bit disappointing, like the Richmond Manufacturing Index that came out yesterday. Expectations were for +9, number came out to be -11. So there are some soft patches that will keep the Fed a bit more retrospective about this. But we think certainly until the Jackson Hole speech, until in late August, we think that markets are going to enjoy this rather calm, relatively benign environment before we set up for probably some more trouble ahead.
Hi, morning. What seems to be dictating the market moves today, or at least for the banking pack, has been the RBI announcement now to, in terms of more measures to address the forex volatility. Would you say that really is the need of the hour? Control the volatility in the forex market and control the current account deficit. Was that really the proactive approach by the RBI? And would you say, is it too little, too late?
Well, I think many in the market have been arguing that the RBI, and really not so much the RBI, but really the government, needed to have moved a lot further in terms of solid consolidation of the fiscal deficit. That is starting to happen, although in an election year, again, that remains a concern. I think also the measures aimed towards the trade deficit are also another thing that is very much at the forefront of investors' mind. Now, I think the thing about the Indian rupee is that it's actually quite an expensive carry trade to put on. So, for example, when you are going long dollar INR, effectively you're having to pay away 7% in terms of funding on an annualized basis to be able to do it. So what you will see, I think, in the Indian rupee is periods of relative calm followed by potentially sharp movements lower. Now, I think that this move is not yet over. It's quite interesting that the RBI has felt it important to move so quickly after the last measures. And in fact, what happened was that after the last measures were introduced, you had a brief rally, and then the Indian rupee went straight back to the level where it was to intervene again. I think the other thing that is concerning markets at the moment is the continued exodus of foreign investors from the bond markets, the way that some of the bond auctions are going, and the way that 10-year bond yields in India seem to be moving higher. Against all of this, it's actually quite surprising that the equity market is holding up. The banks obviously not doing so well, but as you just discussed, some of the other sectors like IT are doing fairly well. But overall, from a market perspective, I think we prefer China to India on a relative value play.
So, Mohammed, I mean, what is your prediction when it comes to the equity markets? Because all of us are surprised here, given the macro situation right now and the currency volatility. The equity market seems to be moving in another direction. We're already sitting at 6,050
Yes.
sort of levels. Do you see this trading range actually play out for some more time to come? Or do you think eventually the macros would begin to dictate the market moves and we will see significant downside?
Well, I think eventually the macro is going to dominate. But I think at the moment, what we are seeing in markets across the world is that macro is actually taking a bit of a second seat to earnings and single stock situations. In fact, correlations in markets appear to be falling right now. And that is a good environment for stock picking and alpha generating activity. So that is happening right now. I think the other point is that if you look at expectations for earnings in India were around zero, and the market seems to be, or the companies seem to be beating on that zero expectation. The contrast with that is some of the other markets across the region where the macro is actually quite good. You're actually finding that the earnings are actually underwhelming. And so what we are seeing is in an environment where the earnings are to the forefront, at least for the next few weeks, the countries with good earnings seem to be outperforming. But I do think that eventually this will come back. And certainly in late August, early September, if the dollar resumes a bid tone again, it will be very interesting to see which markets will be able to swim when the tide is actually going out.
So in the near term, would you say the upside is capped around 6,100, 6,150 levels, or is there a fair chance that the market could leap even higher?
I think there is some room for upside, but I think it's very limited. I think people are going to be very cautious when it comes to committing more money into India. I think the thing about the Indian equity market is that there is very much a divergence about where the money is actually going into. So if you look at India, amongst the BRICS countries, has got one of the highest proportions of consumer staples and defensive names. And a lot of those continue to be bid up. So for example, if you look at names like Hindustan Unilever, continues to be bid up, regardless of the fact that many fundamental analysts are quite negative on the name. And so if we look a lot across the emerging markets portfolios that there are from the international emerging market portfolio funds, what we're finding is that there are some very sharp and significant overweights in selective names that are in India, and they happen to be some of the large caps, which is helping to support the Indian equity market. If you look at some of the other places, you are actually seeing some very significant underperformance, for example, in the banks, as well as in those companies that have significant foreign currency borrowings offshore. So it does seem to be a tale of two markets. I think the index itself belies the reality of the picture that is going on underneath. But I think the Indian rupee story is not yet over, especially going into the second half and when talk of an election is likely to resurface.
Mohammed, whereas you are bullish on China, some would argue that India is the tallest off when it comes to emerging markets. China is experiencing a self-engineered slowdown. There is a social unrest in Brazil. We know what's happening to Turkey. So clearly India is standing out.
Yes, I think that is the case. I think it's a matter of magnitude. I'm not sure whether we are calling for anything more than a short-term trading bounce over the next 6 weeks. I think if you look at the Indian equity market is within spitting distance, maybe about 2 or 3% of all-time highs, whereas the Chinese market has fallen around 20%. And really, this is a call on a weaker dollar over the next few weeks. Now, I think the dollar is going to be weaker against a lot of the major currencies, but against currencies like the Indian rupee and the Indonesian rupiah, we don't think that there's going to be very much of a rebound. Certainly, the market appears to be very positioned for a rebound in the Indian rupee, which is probably one of the reasons why any strength is likely to be relatively muted.
So what's the right approach right now? Pile up further into names like an Infi, TCS, Tech Mahindra, Unilever, ITC and the likes, which have been holding up pretty well?
I think that the momentum trade is going to continue. I think the question is really whether the marginal moves from the RBI are going to be more or less friendly to the companies that have underperformed. And in particular, I would focus again on the banks and the companies with large foreign currency borrowings. It would appear that there are likely to be more moves to stem the volatility. I think press reports in India are already starting to talk about potential rate hikes if the Indian rupee gets to 61 or 62. I'm not sure whether that is the case or not, but it's certainly interesting that the market is starting to talk about that. And in that environment, it's unlikely that some of these underperforming sectors are going to rebound until we get to see that the end is in sight for the Indian rupee volatility.
Mohammed, so if you have to, let's say, allocate $1 million into Indian stocks, what kind of portfolio allocation you would follow? Or $1 million is too less for you? Let me make it 10 million.
I think I would probably be, in terms of positioning, probably fairly neutral in terms of the market, maybe have a slightly long bias. I think I would be short the banks, especially the banks which are exposed to the loan-to-deposit ratios, exposed to high levels of bond holdings. I think one of the good trades out there is to short the ICICI Bank ADR premium, which is at 10%. If you look at stocks like TSMC, which was a market darling, those are now trading at parity relative to the local shares. And even ICICI Bank was trading at parity relative to the local shares about 8 or 9 months ago. So to me, that seems to be a very good trade. Hindustan Unilever, I think, is confounding a lot of clients, but I continue to think that's going to get a retail bid. And some of the IT names are going to remain fairly well supported as well.
Mohammed, good chatting with you. Really appreciate you taking the time out and speaking with us today.